Hello and welcome back to All Things Money. I'm your host, David Blain. We thank you for joining us today. We're talking about some timeless investment principles that you can use in your own investment management if you're managing your own portfolio. One of the principles we have that I'll get to in a minute is we do believe that with the help of a competent fee-only advisor helping you along the investment path, you'll be better off in the end. So we do recommend that, but for those of you that want to do it on your own, we're trying to give you some information to help you manage your portfolio better. This is going to be our last show for a while. As I mentioned in the first segment, we've got a lot of stuff going on at D.L. Blain. We made a major acquisition. We've more than doubled the company size in the past month, and I've got some things to do. We're going to continue to post some fresh content on our website. We've got some other advisors that are going to be writing some articles and possibly doing some homemade videos and things like that. So head on over to the website, dlblain.com. We'll continue to have some good content for you. Our communications director, Jeb Colliers, always has some information, but I personally will not be able to do the show for quite a while now. So we want you to keep up with us there on our website. All right, so back to the investment guidelines. We were talking before the break about ignoring the short-term behavior, and I used the analogy of the weather when, picking a place to live. If you're looking at, you like the warm climate, well, you may pick Florida. Well, why is that? Well, certainly on any given day it may be cold there, but in general the climate is hospitable. The same thing with investing is you want to look at, in general, how does an asset class perform? In general, how does this investment do? And stay away from the day-to-day gyrations of the markets. It will. Another good example is your home. Home prices go up and down in value all the time. And if someone comes to your door and let's say you have a house that's worth $250,000 and it's Saturday and you wake up and you're out cutting the grass or something and somebody pulls up and you turn off the lawnmower and they say, "Hey, I saw your house. I love your house. This is the best house in the world. I want to live here and I'll pay you $150,000 for it." Well, you say, "Gosh, my house is worth $250,000. Who is this crazy person? No, I'm not going to sell you my house. Go away." Well, the next weekend you're out there trimming your hedges and the same crazy person comes up and he says, hey. He's like, "I changed my mind. I'll pay you $350,000 for your house this week." You say, "Wow, that's a lot more than it's worth, but I really like my house and I plan to live here for a long time, and I'd have to pay capital gains taxes and move and everything. So no, I don't want to sell my house." Well, the same thing happens in the market. As you own a stock, or in our case, you own a basket of stocks, you own the U.S. stock market. And, at sometimes, like in 2008, beginning of 2009, that crazy person is offering you that $350,000 for your house. That the price is a real bargain for your house. Other days, the market's depressed and they're not going to give you a very good value for your house. Well, if you're a buyer, you want that price to be low when you're buying. It allows you to accumulate more investment. So investing, and you've probably heard this before, but investing is the only thing in the world where people bemoan lower prices. Now, if you're a retiree and you're selling off investments to live on, it kind of goes to another one of our principles we'll get to. But sure, in that case, you want higher prices. And so you want to kind of plan ahead and not be relying on selling stuff, for your living income. You want to have some sort of reserve so that you're not forced to sell things as you need it for your living expenses. All right, so another principle that goes along with this, to minimize costs and taxes, you want to minimize your trading. Especially, if you're in the 0% tax bracket, okay, capital gains could be zero. Ordinary interest and dividends, dividends taxed at that, could be taxed at that 0% rate. But as you creep up the income tax ladder, and hopefully you all are as you continue to make more money, taxes become a real issue. Now you could be trading in an IRA account. So granted, the tax issue also can go away there, but you still have trading costs. Even if your broker lets you trade for free, There are a lot of ETFs out there. In fact, we use them that are free to trade. But what you don't realize is there are hidden costs in there. So we want to keep the trading to a minimum, not only because you don't necessarily know whether the thing is going to go up or down. Just remember that for every buyer, there's a seller. For every seller, there's a buyer. So when you're selling something, someone else is buying it. And so unless you have more information or better information than all the other market participants, which you don't, you may think you do or may get lucky for a while, but you don't have better information unless it's illegal inside information. Just remember that someone else is always buying what you're selling or selling what you're buying. Consider low-cost investing very carefully. Over the past several years, 10, 15, 20, certainly over the past 30 or 40 years, investing has changed. As I mentioned in the first segment, it's really become to be dominated by professional, I call them traders, not necessarily investors, short-term trading, institutions, looking at their quarterly numbers, looking at their monthly numbers. And that indexing has become a very viable option to capture the returns of the market. There's been numerous studies that I'm not going to go into today that document the underperformance of active management. So you want to be very careful and consider indexing very carefully. It's not exciting. It's kind of boring to just slowly accumulate money. You're never going to be the best performing investment, but you're never going to lose. You're never going to be the worst performing investment either. Well, that brings us to our second break. When we come back, we'll continue talking about some timeless investment principles. So for All Things Money, I'm your host, David Blain. We'll be right back.